Welcome to The Explainer. Okay, let's get right into it. The clock is ticking towards December 2025, and there's one question on everyone's mind. Is the US stock market about to fall off a cliff? Today, we're going to cut through all the noise, look at the hard data, and figure out the real probability of a major crash.
So this is the million-dollar question, right? It's the kind of thing that can keep you up at night. So let's just forget the breathless headlines for a minute and focus on what the actual pros are watching. The key indicators that tell the real story of the market's health.
All right, first up, let's check the market's internal health. You can think of this as us taking its blood pressure and its temperature. Are the vital signs strong, or are they flashing some serious warning signs? Let's find out. We're going to start with the VIX, which most people call the market's fear gauge. See, anytime this number gets over 20, it signals that investors are getting pretty anxious. And right now, we're sitting at 23.43. Now, that's not full-blown panic mode. That's usually a reading over 30, but it is a really clear sign that the market is on edge and feeling unstable.
Okay, next let's talk about valuation. I mean, how expensive are stocks right now? Well, this is the Shiller PE ratio, and it measures stock prices against their long-term earnings. It's at 40. To put that in perspective, that's a level we haven't seen since the absolute peak of the dot-com bubble. It suggests stocks are, historically speaking, way overpriced, which means any little piece of bad news could have a huge impact.
In this right here, this really captures the mood perfectly. Major indexes like the S&P 500, they've basically given back all of their recent gains. When you see a reversal like that, it's a classic signal that the buyers, the bulls, are just running out of steam. And you know who loves that? The bears. They're starting to take control.
Okay, so the market's internal vitals, they're looking a little shaky. So now let's zoom out and look at the very foundation it's all built on, the broader economy. Are we standing on solid ground, or is it starting to crack under our feet?
So the first big crack in that foundation is inflation. As you can see, it's just stubbornly staying above the Federal Reserve's 2% target. This sticky inflation basically ties the Fed's hands. They can't really cut interest rates to help out the market, because if they do, they risk this painful surge in prices all over again.
And what makes it worse is unemployment. The rate has now crept up to 4.4%. Now that number might seem low, but it's the trend that matters. An upward trend is a textbook sign of a slowing economy. That points to less consumer spending and, you guessed it, weaker company profits down the line.
So all this puts the Federal Reserve in a pretty much impossible position. Just look at these two options. Option 1, they can cut rates to try and boost the market, but that risks letting the inflation dragon out of its cage again. Or option 2, they hold rates steady to fight inflation, but risk triggering the very market crash they're trying to avoid. There's just no easy way out of this. Now, beyond all the general data, there are 3 very specific red flags that analysts are watching like hawks. You should think of these as the biggest clues in our whole investigation into a potential crash. Our first warning sign comes from, believe it or not, the world of crypto. Bitcoin and other digital assets are often seen as the canary in the coal mine for riskier investments. Why? Because when investors get nervous, this is one of the very first places they pull their money from. And that is exactly what has happened. Bitcoin recently plunged by a third, dropping from a high of around $120,000 all the way down into the $80,000 range. A drop this sharp in the riskiest corner of the market is often a leading indicator for what's about to happen to other high-growth assets like tech stocks. Our second warning comes from one of the most respected investors on the entire planet, Warren Buffett. You know, when the smart money makes a big move, it really pays to listen. And right now, Buffett's biggest move is to just sit on the sidelines.
And look at that number. It's just staggering. That's a record $382 billion in cash that Warren Buffett's company, Berkshire Hathaway, is holding on to. He isn't just avoiding buying stocks. He's actively selling them and hoarding cash. It is really hard to imagine a bigger vote of no confidence in the market from the Oracle of Omaha himself.
And finally, we have what might be the single most reliable recession predictor in history, the 10-2-year yield curve. For decades, this indicator has had an almost perfect track record of signaling when an economic downturn is coming.
So, what is it? Well, normally, you get paid more interest for locking your money up for a longer time. But when the curve inverts, short-term bonds suddenly start paying more. It's this powerful, rare signal that investors are deeply pessimistic about the near future. And, yeah, it's been one of the most reliable recession predictors we have.
But here is the most critical part, the thing that almost everyone misses. The yield curve was inverted, and now it has uninverted. It's gone back to normal. But history shows the crash doesn't happen during the inversion. It happens in the 6 to 18 months after it normalizes. And guess what? That means we have just entered the danger window.
Okay, we've looked at the market's vital signs, the shaky economy, and those 3 huge red flags. So what does it all mean? Let's put all the pieces of the puzzle together and look at the most probable outcome.
So putting all this evidence together, the consensus doesn't really point to a massive 2008-style collapse. While the probability of a full crash, which is a drop over 20%, is sitting around 15%, what's seen as far more likely, with a 60% probability, is a market correction, a significant but much less severe drop of 10 to 15%.
So if you're only going to remember a few things from this whole explainer, please make it these. The most powerful signals to watch right now are Warren Buffett's gigantic cash pile, the fact that we are now inside the yield curve's historical danger window, and the fading enthusiasm of smaller, everyday retail investors.
And that brings us to our final thought. The data doesn't suggest you should panic, but it absolutely suggests you should prepare. A correction seems way more likely than a total collapse, so the final question isn't if the market will fall, but how you're going to react when it does. Knowing a 15% drop is a pretty high probability. What's your plan?